Okay, let's take a look at this earnings per share problem where we're given a company with a simple capital structure. On January 1st, Lennon Industries had stocks outstanding as follows. And I got a typo there. Let me correct that. That's better. 6% cumulative preferred stock, $100 par value, issued in outstanding 10,000 shares, and we've got a million of it that you can see there. Okay, let me make this a little bit wider here. Common stock, $10 par value, issued and outstanding 200,000 shares. So 200,000 shares at $10 gets us $2 million of book value of common stock. Okay, then the company wants to acquire the net assets of three smaller companies. And the acquisition took place, as you can see in the schedule right here. So on April 1st, they issued 50,000 shares. And then on July they issued 80, and October 1st they issued another 30,000. And in this paragraph it also says that we assume the company's board of directors authorized the issuance of an additional 160,000 common shares. Okay, on May 14th, Lennon realized a 90,000 before tax insurance gain on the expropriation of investments originally purchased in 1994. And at the end of the year, Lennon recorded net income of 300,000 before tax, and that should say exclusive of the gain. And again, I've got a typo, so let me quickly correct that. It needs a C in there. That's better. The instructions are to assume a 50% tax rate, compute the earnings per share data that should appear on the financial statements of Lennon Industries as of December 31st, 2008, and assume that the expropriation was extraordinary. Okay, now I'm going to switch to another page here, and the writing's going to move a little bit because I've adjusted the columns. Okay, and I've also slid down a little bit so we have a little bit of room to work. Let's bring, and I worked a little bit of this ahead of time just to save the time of having you all just watch me type. Okay, so what we need to do is we need to create a schedule of weighted average number of shares, because we're going to need that when we get to the earnings per share data that we need to put together on the face of the income statement. All right, so let's put a couple pieces of information together, like the column headings. So we know that the dates outstanding, and now I haven't worked ahead, so I'm just going to type this out. From January 1 through April 1, we had shares outstanding of 200,000, and we're getting that from essentially right above my mouse right there, the 200,000 of common stock that was available. And that fraction of the year is 3/12. So I'm going to actually enter that as equal 3/12. They'll come out to 25%. Okay, let's keep going before I do the weighting of the shares. Then from April 1st until our next acquisition, which was on July, and it's right here. It's the years are cut off a little bit, but there's enough there that you can see it. April 1st to July 1st, we issued the 50,000 from Company A was in effect, so our shares outstanding are the 200,000 plus the 50,000 above, right? So we have 250,000 in April, May, June, and July. Oh, it's only July 1st, so it's April, May, and June is another 3/12, right? And it's a date format, so let me fix that by switching that format, and we get another quarter of the year. Okay, then on July 1st we issued the 80,000 shares, so now we've got from July 1st until, when's the next acquisition? Looks like October 1st. We have to show the increase of that 80,000. So actually we'll take the shares we had before, the 250, plus the 80 that occurred on July 1st, and we're up to 330. July, August, and September is another quarter of the year. So I'll just copy from above, and again it's 3 divided by 12, 3 months. And then finally, for the last quarter of the year, we go from October 1st to December 31st. And the shares outstanding would be the shares outstanding previously, plus that extra 30,000 that we issued when we acquired Company C. And again, another 25% fraction of the year. Okay, so then all we need to do is multiply these across to come up with the the calculations we need that we can then just add to come up with the weighted average. Now, if we've done this right, the fraction of the year should sum to 1, right? And we really don't need to put this in, but I'll do it anyway. There's our 1. So if we actually were to put these in fractions, which is okay, then we see that you know, we've come up with 100%, so we've weighted this correctly. And then if we sum on down, we can simply come up with the value we need, which is our weighted average number of shares outstanding. Okay, now I'm going to take the fraction of the year off of there because that really isn't necessary, and it's that 285 is what we're really after. Let me slide a little bit so you can see a little bit more of that. Okay, and we're going to need that 285 in another calculation. I probably should format this and go to, let me bring this up so you can see what I'm doing, and go to font and double underline, right? Okay, and then we get that nice format that we need. All right, now let's slide back up. We'll keep the 285,000 weighted average in mind. We're going to use that as we solve the rest of the problem. Okay, now let's bring a couple things to light here. Now we need to put together the income statement. All right, and I'm just going to bring some of this to light that I had worked ahead of time. Income before income tax and extraordinary items is 300,000, given right there in the problem. The next item we need to consider is income taxes, and income taxes would be equal to, I think it's 50% tax rate. So we can take that 300,000 times 50% and we get 150. We would underline that. I'm getting a funny just screen refresh, but that's okay. Income tax, and what we get after that would be a new line item. Let me bring this to light, called income before extraordinary items. And the income before extraordinary items would be equal to, let me bring this to the right so that it's appearing as white. I need to get this black, equal 300,000 less the 150,000. So now I've got income before extraordinary items of 150,000. And actually, I don't think we need an underline under that. The next item down we need to consider is the extraordinary event, which is, I've already worked this piece ahead of time if I can get the color to show up. Extraordinary gain net of applicable income taxes, and we need to calculate that. Okay, so I'm going to do a quick calculation here where we know the extraordinary gain is 90,000. Okay, and with a 50% tax break, a 50% tax rate, the 50% taxes on that would be equal to $45,000. Well, it's lucky that it hits 50%. I can leave that as the net amount because the other 50%, or I should say the extraordinary gain less the taxes, is still going to be equal to 45,000 since the tax bracket happened to be 50% right on the mark. So I'll type in 45,000 here is the amount of income tax. Remember, you need to disclose the income tax on the face of the income statement. Now, let me slide up to give us a little bit more room. And after that, we can compute net income, if I can spell it correctly. That's better. And we could underline this and come up with the 150. This time it's plus the 45,000 because it's an extraordinary gain. And it comes out to be 195,000. And again, I'm going to format that with a double underline. I think I've even put a button on my ribbon bar, which you can't see, or on my ribbon to make the double underline go faster. Okay, then we need to put together the per share of common stock. And we list per share of common stock, and then we essentially duplicate what we've done. Extraordinary gain, only this time we just say net of tax, and we can come up with net income. Okay, now remember we had to do that calculation of the 285,000 that we saw back here, right? 285,000 right there. So that's our weighted average number of shares. We're going to need that. And we're going to first come up with income before the extraordinary item. And to do that calculation, put the focus on cell E31, and we know it's going to be up, and I've still got these appearing in the wrong color, so let's see if we can see it now. There we go. Equal the income of 300,000 divided by that 285,000 shares. And if we format this correctly, we get $1.05, but we also need to consider the preferred stock. Let me slide up. Okay, 6% cumulative 100 per share means that there's a portion that we're going to expect to go to preferred shares. And why don't we do a quick calculation of that down below. Now that number's not correct. We still have to subtract out some things, but let me just slide on down, give us some room, and we'll do a quick just a quick calculation here where we'll figure out what's the preferred shareholders' dividends that they're going to get. Okay, what we know is preferred dividends were $1 million of face value. I'll just do it, we'll do it here. Right? And it's a 6% dividend. So we'll just drop in 6% here, and we know that we should get $60,000 of dividends. Okay, but we could do this in our head, but I wanted to show this sort of the long way, and we don't need cents to show preferred dividends. Okay, now once we have that, we need to adjust this. We originally started with the 300,000 divided by 285, but that's not correct. We need to take what the 285, the 300,000 of income before tax, and then subtract out, and I'm going to just point to the 60,000, which is in cell C39, and close it up. Now hopefully you see I'm working here. So I take what's in cell E24, which is 300,000 minus 60,000, and what we come up with is a new amount of income before extraordinary items. Now, one thing I've noticed is I was doing this as if it was income before income tax and extraordinary item. And that's not what we need to do. We need to make this income before extraordinary items. So instead of that being cell E24, that really should be cell E26. Okay, so we take income before extraordinary items, subtract out C39, and divide it by the 285,000, and we get 32 cents, and that's the income before extraordinary items. Then we have to figure out the extraordinary gain, and to figure out the extraordinary gain, we would take the 45,000 and divide that by the 285,000 shares. And the reason why we don't have to be concerned with the preferred shareholders anymore is at this point their dividends have already been considered in the income before extraordinary items. So if we format that, we come up with 16 cents. And then from there we should just be able to add that together to come up with the next dollar amount we need, which comes out to be, I got to figure this, 474. Actually, let me show the way we really should do that. We need to take, to come up with the net income amount, we need to take the net income available. Take the net income available to common. So what we could take is the net income of 195. Let me do it this way. E28. Okay, and back off the 60,000 to preferred. This is another way of doing this. And dividing that by 285. And we come up with 0.47 cents. Now, it actually comes out to be 0.474, and it's probably customary to round that to the cent up. So rather than rounding it, I'll just key it in as 0.48, and you can see that that makes those two numbers add in a correct fashion for a user to comprehend. And that is what's required on this problem, everyone. Thank you.